used my gimbal yet I've used it one time actually to
I've been
record
trying to look
outside.
at your TikTok, see if you have used it or not, because I've just seen the ones of you actually like running and bobbing. So I've been waiting to see for that one.
It's too bulky to like hold. Like haven't figured out how I'm actually going to bring it out on runs. I brought it out on a cycle ride, and so I was able to like prop it up on its tripod and get a cool shot with like down the hill, and like there was like a nice little background and
There's a
whatnot.
pretty nice bike you got there. That thing was pretty
Yeah.
intense.
Uh-huh. An Orbea, something like that.
I have this
Not
free
bad.
I have this free one from when we had the beer business, and it's like a Jeep bike or something with a Miller Lite
Yeah.
sticker on it, and it's like those gears that you
Yeah.
turn. They're on your grip, so it's not great. But I've ridden like on the trails up north here, like 10 miles on that thing.
I'll tell you though, the bike is nice, but the seat hurts my ass so bad after like 5-6 miles because it's like it's no cushion. It's just supposed to like form to your butt cheeks. I don't know the science behind it, but the guy was telling me that that's what's supposed to happen, and then you're supposed to get the biker shorts with the pad in there. Man, I don't have biker shorts. Let's just say that. And I was waddling after I went on a 13-mile bike ride last weekend, just not feeling good whatsoever.
Yeah. Are you still waking up at 4
Brutal.
in the morning?
Absolutely. Been
It's
doing it now
impressive.
for quite some time. All right, let's rock this thing, Drew. Hello and welcome to the Neighborhood Money Podcast. I'm Cavan and that's Drew. And this podcast is all about helping you build a life you deserve. We're here to talk about money. And today, specifically, we're here to talk about retirement investing, one of my actual favorite topics in the personal finance space. I know a lot of people don't like it. A lot of people are anxious about it. And sadly, a lot of people don't even look at it until it's, further on down their career. But it's actually one of my favorite things. So, Drew, I'm really looking forward to this conversation. We've done episodes like this in the past, but I think this one's going to be pretty awesome because we're going to hit high level all of the different things to consider. We're going to talk through what Drew and I are doing individually and give you some ideas and tips around what you should be considering and potentially doing. I will have a little caveat here, Drew. This is not financial advice. I feel like I have to say that because of our legal system, and you can get screwed if you don't. But this obviously is not legal or financial advice. So let's get that out front.
I like it. Yeah, no, it should be a pretty exciting episode with talking about retirement, for as exciting as that is for everybody. No, but I think it would be a good conversation going back and forth, just kind of seeing what's out there, just kind of seeing what to do in such a weird environment. And spoiler, it's really nothing different than you should do.
I was just going to say, should we start there with the environment? And if you are getting started, or even if you are investing into retirement, what should you do in this type of market? And I think, Drew, you already answered it.
Yeah, spoiler, just like keep going on doing what you've been doing as long as you have been investing. If you have not been investing, there's no better day than today to start, or at least get involved in just seeing what's out there and getting that light bulb to go off and just get curious about it.
So, what should people be doing, right? I think that's the natural question of, well, what should I do if I'm not investing? And I think one is you got to start looking at what type of investment accounts, specifically retirement accounts that are going to give you a tax benefit, are available to you.
I would say, for one, tax benefits are definitely something that you want to search for. And I think for two, it's just everybody's life is so busy. There's no reason to make it more complicated than it has to be. So you don't have to be this big stock wizard. You don't have to be looking at your account every single day. You don't have to be looking at what's the best stock for every day. It's just for these busy lives that we have, for you to continue to have success in the future, is just being able to find a way to automate this investment portfolio of yours, where you can put it aside and you can let it grow, and you're not having somebody else do the same thing as you, but then say they're managing it and then taking a percentage off of it.
There's a book, Drew. It's right behind me. It's the little book of common sense investing. Absolutely love this book by John Bogle. If you guys
I've never
haven't
read that
read it,
one.
pick it up. It's awesome. But it talks about actively managed funds versus passively managed funds. So actively managed mutual funds or individual stock picking versus like an index fund. And it walks through, it's pretty detailed around all of the all of the statistics of how actively managed funds have done compared to index funds. And it comes out saying that on, I forget the exact number, but it's like 80 to 90% of actively managed funds in the long term don't actually beat an index fund. And so I think that plays into what you were saying of people being busy, not having the time to look into the market to find individual stocks or pick the right type of actively managed mutual funds. Index funds are, in my opinion, the best option for most people when it comes to retirement investing because of exactly that. Index funds match the market. Index funds, on average, beat actively managed funds, and you're not picking individual stocks and having a lot of risk or downside risk there. And so I think if you want to be the passive, lazy investor, one, pick up that book because you're going to learn a shit ton. But index funds, I think, are the way to go.
The passively invested income, I think, is probably the best. I mean, there's people that will put money into a savings account because they like to have that cash there. They like to have it liquid. But I think as you start to get into a little bit more of investing, you'll realize it's not as hard as everybody says it is. It's not as complicated. I think there's such a barrier to entry because so many people get intimidated by the stock market and saying, "Oh, I I don't want to touch that stuff because I don't know anything about it." And the best thing is you really don't have to know anything about it. You just have to know how to get onto the internet, how to put in some of your information, and then how to just pick one out of many funds where it can be an easy Google search where you say, "What's a good index fund?" It'll pop up maybe like a top 10. Just pick one. You don't even have to know what's in it. Just pick one and then just keep putting money into that month after month, let it grow. And it can even be an automatic deposit into that account. And so, like, you're pretty much having your computer be your financial advisor and being able to continue to invest for you.
I agree with you up to a point. I do think that that is an excellent place to start. But I do think that when you invest, you should at least know what you're investing in. So, because there are multiple amounts of index funds out there. And so you're totally right. Google it, pick one, do a little reading on it. But then once you continue to invest, learn a little bit more about it weekly, every month, or whatever, is appropriate for you, so that you're at least aware of why things are going up and down. Because I think there's power in knowledge there, because there is so much volatility, or there is so much ups and downs in the equity markets, even in index funds, that if you understand why that happens, because you understand what you're investing in, it's going to kind of calm the nerves, Drew. It's going to make sure that you're not pulling out when the index or the investment is low and buying in when the investment is high. And so I think if you continue just to build that knowledge base over time is super important, but getting started is obviously the most important. And so you're totally right. Just find an index fund, figure out which one works for you, and just automate that each and every month.
Really, for me, like, I think this kind of brings us into like one of the first vehicles. I think we've talked about it quite a bit, is like an individual retirement account, or you hear an IRA. And when you start, say, a Roth IRA, that's something where when we're saying you can just go in, just get started, you pick some type of index fund, and as you start learning about it and as you get more excited about these type of products, the great thing is, when we've talked about at the beginning of this episode, is these tax advantages that you can play on, is these Roth IRAs. As long as you're not withdrawing this money and taking out of that account, you can buy and sell these index funds when you feel more comfortable about switching to a new one without having any tax events. So if you made 100,000 or $100 or $1,000 on this index fund and you wanted to switch to a different one, you could sell that, buy the next one. There's no tax event, and you still have that cash value, all of it poured into your new index fund, and that can keep growing until you decide to learn more and then pick something else, or you maybe be really happy with that. So I think as far as tax advantages that you can do for your future in retirement, a Roth IRA is something that's great to start with because you don't have to worry about being employed. You don't really have to worry about your employer giving you that option. There's no waiting period of, say, it's 6 months or a year before you can actually get onto that plan. You can start that Roth IRA right away. I mean, the downside, you can only put so much into it a year, but the upside is you can start whenever and you can still have those tax advantages.
Why don't we step back a little bit? We're kind of getting into like the accounts, the investments, but Drew, what do you think about just how much should someone invest when they look at retirement? There's a lot of rule of thumbs out there, but what do you think is an appropriate amount of money generally for people to start with when looking to invest for their retirement?
Really, I like to just start with like that max that you can do out of that Roth, and what's that, 6,000 a year? It's about $500 a month. I think that's just like a great spot to start. I know not everybody's able to do that right off the bat, but if you're able to, if you started a budget, you're working around that budget, and you can actually just figure out if you can get that money in there and still continue to live. It doesn't have to be necessarily the way you're living before, but then you can find other ways to make income. But I think if you can start out with that, I think that's a really great option. As you get into it more, I think you can start going off of percentages of maybe your gross. And then if you can get up into, somewhere in that 15%, I think that would be like phenomenal. I think you do really well with that. I think that takes a little bit of time and working around your numbers to make sure that. Uh, but at the end of the day, as long as you're putting money in and you're using that compounding interest on your side, that's like the first step that you have to do. And I think it's one of those big items in your life, or big events in your life, where if you don't jump into the deep end right away, you kind of have to just slowly settle in and figure out how it works with your finances and then continue to grow on that.
I like that because that's kind of how I think about it. I think about it in buckets. So you have the people that have a new job, young, don't need a whole lot to live, although they like to potentially spend a lot of money to live. That type of bucket, I say, go right away to the 15%. You've already been living, like specifically if you're coming out of college, most people in college are broke. You've been living broke, continue to live broke, put away 15% each and every month, and it's going to pay dividends, huge dividends down the line, because you're not increasing your lifestyle when you get that job, and you're tucking away a ton of money right away, and that's going to help. Now the other bucket, so I said there's two buckets away. I think the other bucket are the people that haven't started yet, but they have responsibilities, right? So think about people that have car loans, mortgages, kids, pets, even, because let's be honest, pets can be so expensive now. Those people probably can't just dive right into 15%, right? Like it's would be a drastic life change. But I think you're totally right. You start with, maybe it's not a percentage, but I kind of like to sit with the 6%. That feels right. Really, what you can go off of if you want a better rule of thumb is, and if you have this option available to you, if your employer gives you a match, hit the match. So whether it's 3%, 4%, 6%, put in that amount of money. If you're in that bucket of someone that has the responsibilities, but is really wary of putting money away because of the lifestyle they've built. Now, I will totally agree with you too that, hey, 15% is an awesome goal, but I'm going to push it a little bit farther because I truly think that you should try to invest a little more. But here's the caveat to that one is up to 15% only count the amount of money you're investing. This is specifically what I do. 15% is the amount of money you are specifically investing. Now, beyond that, you can count employer matches. And I really like that, Drew, because that gets you now into the 20, 25% potentially, depending on what your matches are. And so I think if you can sit in that 20 to 25% of your income over the course of your working career, man, you're going to be living in a sweet spot come 50, 55, 60, where you're going to be able to do everything you want and really not be subject to really having to live on a tighter budget when you get to retirement?
So I'm going to throw this conversation a little bit on its head here, if that's the right phrase for it.
I
And
like it.
so for me, I love the foundational principles of like personal finance. It's, having your budgets, reducing your debt, investing long term. But one of the things that has been on my mind a lot the last probably 2 years specifically has been, it's great to have an account that you can set aside. And it's like, if you just have to know what you end up kind of wanting for your retirement, what you want in the future. So like you can have something on your side, but if you're okay with working till you're 50 or 60, I think that's all you have to do. But if you're somebody that doesn't want to do that, and like if you want to have more time, I've been really into you finding other ways of making income. Like I think you can live very comfortably on like an index fund. But I feel
For
like
sure.
everybody wants to live more than just comfortable. They want to be able to go out and do whatever they want. They want to be able to enjoy it when their body's healthy. And so I think on top of all this passive stuff, I think there's something in us that we should try to find some type of like side hustle or something that can build really that like true wealth. And it might be different for everybody. It might be somebody just like sells stickers, or somebody builds like a business. But I think that's where my big passion is like the entrepreneurial side of it, where I love the long-term stuff that can kind of set and forget. But I think there's a chunk of that money where it's good to put that towards something that you can build to be a lot bigger. So like even if you have to cut down some of your long-term investments to be able to take that chunk and put it as a down payment for a loan that you took out for an asset that's going to build return and consistent cash flow week after week or month after month, and maybe
For
gets you
sure.
out of the 9 to 5, that gives you a chance to potentially retire before that 60 years old or whatever. And then, I think it's hard for me to actually put it into words right here. I know we're in a podcast. I should be able to word it better. But,
Yeah.
as far as
Come on,
long
man.
term,
It's been a
I,
year.
I know. But as far as retirement goes, I, I've, a, I have this burning passion in me that I want something more than just a long term
For
investing. I
sure.
think
For
it's
sure.
very good. It's very good to have, but I think that's a conversation that I never hear really. Is like you either hear people are diehard long-term index funds, or you have people that are diehard entrepreneurs. And I just feel like sometimes there can be a world for both to be able to grow. But I think there's more options than just long-term investing for retirement, because I think for me, I don't want to get to just retirement. I want to be able to consistently do something I enjoy doing, and I never really retire, and I still making money with still having free time.
Yeah. I love that you brought this up because this one hits home for me right now, too. Um, so I am an advocate, obviously, for index funds. I've been very apparent or very transparent with that on this podcast. But I totally agree with you that there's stuff outside of retirement that you should consider. And while I do still believe that you need to build true retirement money, that foundation first, I think once you get to a point of retirement investing, and Hannah and I are pretty dang close right now, where we're still going to save 20, 25, 30% of our income, but we're going to not just put that towards Roth IRA, 401ks, HSAs. Now we're starting to consider, okay, well, maybe we pull back on the actual retirement accounts because we funded those pretty well. Maybe now we take those, maybe we drop it. I don't know what the numbers actually are, but we drop it to 10% to retirement specific accounts. Well, now we've got 15, 10% or whatever the numbers are. I'm just spitballing here. What if we now start putting that to another account, like a savings account, and then also we're going to go buy real estate with it, or we're going to go do, build a business, or we're going to go buy a business, whatever it is. We're specifically thinking real estate right now. But I think that is and I totally agree with you. People don't talk about that, but I think it is such a great idea for your long-term wealth building. But I still think it's very important that you build that retirement base early on, and then you start taking more of those risks, because you're kind of covered. Because if you fail, and you most likely will fail at some of the businesses or some of the real estate or
Yep.
something that you
Statistically.
do, which is fine.
Yep.
And you can build and grow off of that, but you still have that bedrock that's sitting in the background, building compounding interest. And so maybe that retirement account at retirement isn't, I don't know, $2 million. Maybe it's only 750,000, but you still have that 750,000. And let's say 10 years from now, you're like, oh, let me pull back. Hey, this real estate investing, it's not working. My business is not working. I'm just going to go back. I'm going to go back and invest in my retirement accounts. I'm happier that way. I know it's working. And then all of a sudden now you get that retirement account back up to a little bit over $1 million. So maybe you lost out on $1 million, but because you had the opportunity to take those chances, you built that foundation early on, you still got a really good setup and pool of money to live off of in retirement, and taking the chances of building real estate or whatever that actual, the endeavor is.
Do you still remember those numbers for the compound interest? I know you brought a statistic quite a few episodes ago here, but it was like, if you were to somebody that just started investing and then stopped at, like, so say you started at 18 and you stopped at 30. I mean, that money keeps compounding, and you would end up having more money at retirement than somebody that started at 30 and consistently went till retirement. And so if you were to have that foundational investing, that past stuff on the side, that's just kind of there. And then, later in your life, you decided to pull back and put it towards or put that cash flow towards other items. That stuff you have in the side, that foundational retirement, is just sitting there still making interest. You don't have to put money into it for it to make interest. The money that's in there, that cash value, that investing value, is going to continually grow, which is awesome. So while you're working on other things, that money's still working for you. But if that money's never in that account, it can't work for you.
Exactly. And that's why I think it's so important to have that foundation built before you go off into other type of investing. And I think real estate's a really good one. And if you want to go all in real estate, there's nothing wrong with that. There's a lot of people that make a lot of money. I'm not an expert in real estate. I haven't done it. I've read a couple of books on it, but that makes me a novice at best. I've never actually gone and made offers or anything like that. But that's a very good option too.
That's one of the things for me too. I love real estate. I want to get into it eventually. And I just, my brain, I tend to have this analysis paralysis, I think is what they call it.
Yep.
I'll go gung ho. I'll try to learn all the ins and outs of something, and I'll get to the point of I want to go find an offer, make an offer or something, or find an offer. And then I don't know what comes up. I just have to run the numbers again, and then it just slowly fades away. And I got to get past that, because I feel we've had people on this podcast that have said it just takes your first one. You have to get the first one out of the way, and then it's it just compounds on top of each other, just your investment account. And so I think real estate, I really, really enjoy. I dove really deep into that. I think I see myself in the future somewhere in the real estate realm. I just need to get over my fears, I think.
I think the analysis paralysis hits most people, though, when they even start into investing. Think about if you have a 401k at your employer, you have this account, but then you have a load of options to choose from, right, Drew? And that in of itself can lead to analysis paralysis, because you have a ton of options. You don't know which one's best. You can see the historical data, but you don't know, should you base your decision off of the historical data? Should you go into more safe accounts? What does it even mean? And so, Drew, maybe we should naturally just dive into briefly what are the different type of accounts and potentially how we are using them. And so, since I've brought up the employer first, the main one that comes to mind is going to be the 401k. And these accounts they're named ridiculously, in my opinion. They're named after the tax code, but essentially a 401k, all it is just a tax advantage account for your retirement investing. So if you
From
have a
your
tradition
employer.
from your employer, exactly. So if you have a traditional account, that means that you are going to put money into that account before you pay taxes. So you're
Yep.
delaying taxes. And then if you have a Roth means after tax. The nice thing about a Roth is that once you put money into the account, you never pay taxes again.
Mm-hmm.
And so between those two different types of accounts, just in a 401k, it can be pretty powerful because you are using the power of tax-free either growth in a Roth or tax-free contributions in a traditional account
Yep.
to build that pool of money over time.
Yeah, and I think Roths are becoming more and more popular, and I think that's kind of been the trend the last probably 5 to 10 years. I think most people, when we're talking about a lot of options, is they get initially tossed right into a traditional account. And a lot of the reasonings behind that is when we're saying it's before tax, it like will lower. This might get some people confused, and I apologize because I'm not great at wording this. So like with those 401ks, they drop your taxable income. So like that percentage that goes on your income, it's lower. So like you don't get taxes that much. And a lot of businesses like to do that and push you into traditional is because then their taxable amount that they have for withholding and they have to match and put in tends to be lower. So it makes sense for businesses to do that. And a lot of times people don't even really think about the Roth or get pushed in the Roth way. Or you don't get as much, say, like a lot of companies won't match on the Roth. And
Yeah, my company doesn't. We don't
it's
get matched in the Roth.
and
Well,
it's
we
because
get
of the
matched, but they put
business.
it into the traditional
Correct. So you'd
account.
have to have so now if you're somebody that's intimidated by it, you get pushed into a traditional and then
Yep.
you might have to be like, "Oh, I heard about a Roth." So then you have two retirement accounts that you're trying to put money into, and then you kind of just get confused that way. And then, if they give you a sheet of saying, "Hey, I just need you to pick one of these," that's when that analysis paralysis can come in because you end up saying,
Right.
"All right, I have a sheet. I'm going to take home. I'm going to look at it." You have no idea what's up and down. And then you're like, well, I'll just look at it tomorrow night. I'll look at it the next night. I'll look at it next week. And then next thing you know, you don't even enroll that year. And then next year comes around and the same stuff happens. So like it became.
And you increase your standard of living, how much you're spending. All of a sudden, you're like, hey, I actually don't have any money to invest. And it's just like this cycle, this death spiral cycle to be doomsday-ish, but it is a snowball effect.
Yeah. So I mean, that was like one of the things too. It's like when you ever like go into that 401k, there's just two of the things that you have to think about is like, do you want to pay taxes now or you want to pay taxes later?
What do
And
you think is better, in your opinion?
well, I like the predictability of saying if this money goes in here, it grows. I know how much money I have. I don't know what the future holds for taxes. I highly doubt that the taxes are going to be decreasing, especially on investments.
Say
So,
what?
so the fact that if you can get into a Roth and you're paying current rates now, you know what
Yep.
they are, so it's predictable now. Your money goes in, it grows, and it's predictable when you withdraw because what money's in there is yours, is not getting taxed again.
I am 100% on board with that. I love Roths. That's for the most part all that we invest in. Yes, we do have traditional accounts because of, like I said, specifically for me, if I put money into my Roth, my match from the employer goes into the traditional account. And I believe, Drew, it's because of the tax reasons. But we love Roth because you hit it on the head. You have the predictability. And when you've got that pool of money sitting at however much money you have in retirement, say you have $1 million. Well, to simplify it, if you took all of that out, it's yours. If you had a traditional account, you would have to pay 30%, which is $300,000. And so, yes, obviously you pay taxes over time while you're working, but to have just a huge pot of money yours at retirement, man, like sign me up for that. I'm doing that all day, every day. And I just think it's such a powerful tool to have.
You know what's crazy is I think about Social Security, and if you have like if you're
I try
somebody,
not to think about Social Security.
yeah, it's like so wild to me. So like if you're somebody with like a normal W-2 job and you're constantly putting money towards Social Security, one of the craziest things is in Minnesota, when you are getting your Social Security money when you're retired, that's taxed. So a taxed event or taxed money is being leveraged by the government and then paid out in the future, and then that's getting taxed again. So it's like tax
Well, let's be
money is
honest, man.
getting
Everything you make is tax. Like Minnesota, we get tax on our income, we get tax on sales. Like, how many times does your dollar get taxed, and how much do you
I
actually
just
get to
always
spend?
feel like we pay close to 70% of our income that goes to taxes
You're probably not
by
wrong.
the time sales tax, income tax, property taxes, fuel tax, all of those other type of taxes, I think is wild. But anyways, like with Social Security, if they switched that to saying like we're gonna force you to put this amount of money into a retirement account that's indexed with the stock market, that cash value would grow so big by the time you retire that these people that are getting probably like $8,000 a year from Social Security or like $4,000 a year from Social Security, that money, if they would have just put that into retirement, they probably would be able to draw like 40,000 a year off of that or maybe more. And like Social Security to me just is like the craziest thing because you put money into it every single paycheck and you pretty much at retirement get your cash value out of it and a
Oh,
little bit
less than. I
less
think I
than.
forget the stat, and it's been a while now, a couple of years, but I want to say it was like negative 1 to 2% return is what Social Security provides you
Yep. And
on average.
they just like force you to do it, and then they sell it to you like, "Oh yeah, but you get money when you retire."
Don't get me wrong, there is areas where Social Security is beneficial for certain people. However, when we talk about Social Security in retirement planning, I personally don't even account for it. I say, okay, well, you know what? Social Security doesn't even exist to me. Like, there is no way, shape, or form I am counting that, relying on that in any way for retirement. And I think that's probably the right way to look at it is, can you set yourself up by yourself, saving and investing for retirement to fund your lifestyle when you do retire? And then Drew, Social Security is just icing on the cake. Like, that is just money that you get each and every month that you can spend because you weren't even planning on having it.
I wish like you could see where all of our tax money went, because it feels like the people that like the circumstance where Social Security is needed for some people and it works out, I have would have no problem being taxed to give that money to them. I just feel like for how much income tax that we get, like how isn't that money going to those type of programs or those type of people? Like there's a separate like Social Security one, there's a separate Medicare one, and then there's like our income one that's goes to whatever else. It's just like I think the people that like necessarily don't need it, or like you don't have the Social Security, you don't have the Medicare stuff, and that just kind of comes out of like our income taxes. That's how they
Yeah.
should do
Well, I am no
it.
tax expert
Me
by
neither.
any means, but I do know that a Roth IRA or traditional IRA does provide tax benefits. And I think obviously you already brought up the individual retirement account or IRA, but I think that account, specifically the Roth, so Roth and traditional are the same with an IRA versus a 401k. The Roth IRA is by far I shouldn't say by far, it is my favorite retirement investing account.
Yeah, and it's weird like how they do with these tax codes is you hear a traditional 401k, a Roth 401k, and then you hear a traditional IRA and a Roth IRA. And a lot of people, when you say, hey, maybe you should get into a Roth IRA, they're like, oh, I already have a Roth. And you're like, oh, you do? You're like, yeah, we do it through our company. And it's like, that isn't the same thing. That your Roth through your company is your 401k, the code with the IRS. So that's saying that Roth IRA or Roth 401k is employer sponsored, and then the Roth IRA would be individually on your own sponsored. So that is like something that I think has been confusing for like a lot of people, and I don't think they made
So
it easy.
confusing for
I
no
would
reason.
I would say in the beginning parts of when I was looking into investing, I was constantly uh like confused with that too. Like I was like, yeah, it's a retirement account of a Roth, but it's like it's not an
Right.
IRA. Like an
Yep.
IRA and a 401k are completely, or not completely, but they're just completely separate accounts. And I
Exactly.
think that's something too that I think we can help, talk through, because I don't think that's something that's talked through much either, because a lot of the times with those employer sponsored ones, they want you to all put all your money into that, because then the person that's managing that fund has much more funds in there, and then they get a much higher percentage off of that fund. So you don't really get to hear like all the different sides of it. So I think that's also an interesting thing to add in there is when you hear about these different retirement accounts, there's the 401ks, employer sponsored, and there's IRAs, which are just individually run. So that's something to think about too.
Yeah, you have to go out and find an IRA, right? So Fidelity, Charles Schwab, uh, M1 Finance, there's pretty much an endless amount of companies that are going to offer this, but it's actually you going out, signing up, putting money in, funding it, and then picking the investments within the IRA. So it's outside of your employer. But Drew, what I really like about the IRA, and obviously I said the Roth more specifically, but what I like about the IRA is that it gives you a lot more options when it comes to investing. And it also typically allows you to pay fewer expenses because the IRA market is so competitive, whereas your employer, there's some competition between who's going to manage each employer's plan. But for the most part, you're not getting that optionality because when you go to your employer, like that is your only option as the employee. Whereas if you're going into the open market to get an IRA, there's a ton of different competition. So you're going to have some lower fees, and low fees is actually a pretty big thing when you think about investing. Now, it might not seem a lot, but like 0.1% to 0.5%. So you're talking 0.4% difference seems minuscule at face value. But if that's the difference over the course of your investing in expenses, you're going to have so much less in your account just because of that small 0.4%. So expenses do matter. And that's what I absolutely love about the IRA is that you can lower, if not eliminate, your expenses depending on the company you're going with.
One of my favorite items with the IRA is the flexibility in your investment options. I think that's like the coolest thing ever. So if you open like an IRA and say you wanted to be actively trading and you wanted to look at your phone every single day, you wanted to pick individual stocks, you can do that all day long. You can go in and out of, I mean, obviously there's some restrictions on, um, you can do like 3 day trades within like a week span if you have less than $25,000 in your Roth IRA. But if you're above that, you can do like day trading in that Roth IRA, and you're not taxed on that type of stuff. So like all those little gains or losses you make, I mean, you're just working with the cash value that's in there, and then I think that's like the coolest thing where like an employer sponsored one, they might give you, it looks like a lot of options, but it's just the options that they want to give you. Like if you open this Roth IRA with Schwab or that M1 Finance or TD Ameritrade, you're just trading on the open market. So you can go and buy Facebook, sell it tomorrow, go buy Google, sell it in 3 days, and no tax events. You're not getting taxed, and you're able to still be actively in the market. And I think that's my favorite part about it of Roth IRA is just the amount of options. If you want to trade options, you can do that. If you want to trade commodities, you can do that. If you want to trade individual stocks, index funds, REITs, bonds, you can do it.
That's what I'm glad you brought up the REITs because that's what I really like. And some 401ks will offer REITs or some form of REITs. But I like the fact that for me, I can invest in index fund and I can also invest in REITs, which REITs are just real estate investment trusts. So you're basically investing into real estate through the stock market. We won't go that much further into it, Drew, unless you want to, but it is that optionality. And I love that. But I also love that if you want it to be simplified, you can just do the index fund route. You don't have to pick individual stocks. Like it's all dependent on how involved you want to be and I guess how, quote unquote lazy of an investor you're gonna be over time.
Yeah, if I were to touch on REITs at all, I think like the one benefit on them is high dividends. So like if you can kind of think of a REIT as almost like a non for profit, so like all their profits have to be paid out in dividends to their shareholders. So they tend to have much higher dividend yields. So when you're invested into these, they end up being stocks. Well, they can be publicly traded or they can be private, but the ones you'd be invested in are publicly traded REITs, and you'd be buying them at a certain stock price. And not only do you gain money on the value of the stock price as it grows throughout the years, but you also be paid. It could be monthly, quarterly, half a year or annually on dividends. And I think that's pretty cool because if you like to have passive income and you want to get a little bit into real estate, that's one option of doing it. You don't have to own necessarily a physical piece of property. Maybe you don't get the tax advantages of depreciation and some business expenses, but it's a way to get in there and still be able to reap the benefits of the profitability of these real estate properties.
Absolutely love REITs. I mean, they're basically an index fund for real estate. And I love that. I love the simplicity of them and the fact that you don't really need to know a whole lot about real estate, besides the fact that real estate can be, on average, a very good investment. Now, Drew, what do you think when you are looking at a 401k or IRA? How should people think about using one, the other, both? What are you doing? How do you approach these types of accounts?
Well, I'm currently not any employer sponsored uh, investment. So, like, I'm just in the Roth. So, I like to max out the Roth as I can and just kind of like, I don't necessarily just put it just into index funds. I kind of like to play around with my Roth. But that's just kind of like nature of how I like the market. Sometimes I get burnt on it, but I like doing it that way. As far as employer sponsor stuff, I'm not in anything like that.
Sure. Yeah, that
And
makes
then
sense.
I am really looking into just other types of like side hustles. This podcast is like one of them that we hope to, grow. There's no income coming from this one yet. Um, I also want to look into like some real estate properties sometime in the future. And I think one of like the latest things was like ice vending. I thought was like a
Yeah,
really cool thing. I saw like a
that's
random
wild. Yeah.
I saw a random Instagram person talking about they called boring businesses, and they look at businesses that might be outdated or you don't think they're really fancy, but then adding a little bit of technology to them can really make them efficient and cash flow very well. And I think that's been one thing that's been kind of on my mind. And I'm hoping, like, my goal is to have purchased one in November of this year. We'll see if we actually get there or not, or if my analysis paralysis sneaks in. I think a lot of times my goals are and my dreams are
Yeah.
really high, and then I never actually do them. But hopefully, I can do that one because it seems like that could be something where it would be type of a retirement thing, but you're still getting into kind of a real estate. It's still cash flow as well. You can still use some tax advantages of a business. You can still use some tax advantages of depreciation on these pieces of property, which I think is pretty cool. So that's one thing that's like I utilizing a foundational Roth on the side, and then I'm just trying to find something that can cash flow well as an entrepreneur and just grow on that. So that's kind of where I'm at currently.
Yeah, I like that. I like that a whole lot. If you do, or if you are have the option to invest in a 401k or Roth IRA, or I should say an IRA. I won't just jump to the Roth, even though I am privy to it. Here's one way that you go, and this is specifically what my family does. We always put into the 401k up to the amount that the employer will match. So in our case, let's just call it 5%. So we'll put in 5% to our 401k. We'll put the rest into our Roth IRA. Now, if you max out your Roth IRA, and if you have two of you, you can do two Roth IRAs. That's a really cool thing, is you can have one for each person. If you max those out, you can go back now into your 401k and put the rest of your money. So let's just say you invest 5% into your 401k, you max out your Roths, that gets you to 10%, or let's just say 8%. So then 5 plus 8 is 13. You want to get to 15%. Well, then you can put 2 more percent back into your 401k if you want to use that as your retirement account. And that's actually what Hannah and I are doing. We're leveraging both accounts strategically so that we're getting the best bang for our buck. And really the best bang, the best tax bang for our buck. And then outside of that, you can start doing things like what Drew's talking about, is building businesses. If you want to strictly invest 15% into retirement. And I think that's a really good strategy, Drew, because it allows you to get the full match, because that's free money right now. You're never getting a better return than a match. You're getting into an IRA, which is fully under your control. You have that optionality. You can always have it with you. You don't have to worry about transferring it if you move jobs, or having multiple 401ks if you have multiple jobs over the course of your career. Low fees, like you said. And then if you want to get more tax advantages in a specific retirement account, then you can jump back into the 401k and do so.
It's a great strategy. I think that is like.
Should we wrap that up now? I mean, I see we're like 47 minutes, but
yeah, I kind of blanked out there a little bit, but I would have to say that I think that would be a great way to wrap up this episode. I mean, being able to go through some of these options with retirement, whether it be, I think when we went into this episode tonight, it was just talking about a lot of different retirement options. And as we talk through just our conversation, I think it really is just talking about and letting people know what the difference with a 401k and IRA is. And I think that's two terms people hear a lot, is a 401k and IRA. I think a lot of times, though, people think they're synonymous and they're exact same thing. And I'm hoping that what we were able to talk through can show that they are separate, and there's different ways to get into them, and there's different benefits and downsides to each.
Yeah, I agree. And you're not just subject to your retirement accounts, Drew. I think you hit that pretty well. You can look outside of a Roth or a 401k and IRA. You can look outside of that into real estate, investing into ice machines, whatever it might be, building a business. And that is perfectly okay, because that is still investing for your future. And it's just different. And hopefully through this episode, you got some exposure to that, if that interests you.
If one thing I could bring up with talking about like businesses, there's people out there like wondering kind of where to start, or if they'd rather buy a business that was like already cash flowing. A couple cool sites that not many people might know about is, one is Flippa, there's Micro Acquire, and Biz Buy Sell. So those three, like if you're just somebody that just is kind of curious, maybe what's out there for sale, those three websites, if you go on there, people are constantly trying to sell their businesses to either move on to different type of businesses, or they might be trying to retire, or they are just serial business starters just to sell them and flip them. So I think that's kind of a cool place to start, because you might find something and be like, I can't even believe that was a business. I can't believe it's selling and it's making a couple $100 a month. Maybe I can grow that. So I think that's something to think about too, where if you don't have necessarily an idea for a business or a side hustle, you can go to these websites and you kind of see what's working, and maybe something you might actually want to buy. You could probably buy a business for like $1,000 and be able to scale it.
But regardless of the direction you actually take, whether it's business, investing in through specific retirement accounts, I think, Drew, we can agree that it is just important to get investing as much as you can. Obviously, I love the 15% of your income or more. I think that's kind of my baseline. But it doesn't matter really where you are or where you're starting. The fact is that you just get started, you start investing, you start making a plan, a long-term plan for your money. And it doesn't have to be through a retirement account. It can be through building a business or whatever it might be. Obviously, both Drew and my opinions on that. So, but regardless, it's important just to get started, figure out how you can get that money put away and get it working for you, because time is so important when we're talking about investing. So, but with that, Drew, let's segue over to
Retweet of the
retweet of the
week.
week. Nice. We were almost in sync there.
Almost. I'll go first with mine because I think it's kind of like one that's relevant. It was on the lottery, and there was a tweet.
That was so all the rage last week, man. Like, Hannah came home what day was it? I think it was Thursday night, and she's like, "Cavan, should we buy a ticket?" And I'm like, I'm a math guy. I know all the probabilities, and I'm like, no, we shouldn't. And then she's like, it's 1.2 billion. I'm like, maybe we should head over to the Quick Trip and snag one.
I actually bought a couple, and it's weird to say, but like when you buy it, you almost have like adrenaline, of oh, I'm winning it. And then when you find out you don't lose it, when you find out you didn't win it, and you already know you're not going to win it, but you literally for a little while almost pout and are depressed, you're like, oh, I didn't win. And it's it doesn't make any sense on why you'd feel that way. But anyway, so I saw a tweet and it said, congratulations IRS for winning the Mega Millions. And it caught my eye. I'm like, that's kind of funny. The actual winner was able to take home $433 million.
Jeez.
So
how can you even live on that?
So what's that? So if 1.28 billion, so $847 million went to taxes.
Yeah, it's what, 70-ish%.
So I know you it's a lot of money, and I know you won it, but how does the government get more of your money than you?
It is wild.
Significantly more. So I just thought when they put it into perspective like that, congratulations to IRS for winning $847 million.
They're win-win because they have no risk, right? Because they are getting that regardless of who actually wins.
They're always the winner.
Yeah.
They're always the winner.
It's like the casino house. The house never loses. They're always going to get their money. Drew, I've got a retweet of the week in a very similar vein. It's about the Powerball in a sense, but it's guessing it's the odds of winning the Powerball versus the odds of guessing someone's private Bitcoin key that has a balance. And so the odds of winning a Powerball is 1 in 292 million. Okay. Odds of guessing any Bitcoin private key with a balance is I can't even say this number, but it's 1-962-577-783-683-320. And then there is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 triple zeros. So we're talking
triple zeros.
A massive amount of luck, I would say, so slim of guessing.
I mean, that's showing some pretty good security.
So people always say oh, it's impossible to win the Powerball, because it is. But I just thought it was super interesting, and I'll put it up, showing here on the screen. If you guys are watching on YouTube, I'll put it in the edit. But yeah, it is. I can't even say if that's a gazillion. Is that even a?
Because I know only ones I can think of right now is it's trillion, then quadrillion, then quintillion.
Oh man, this is beyond this is beyond that.
And
Like,
I used to know what was after quintillion because I had some random app that it just showed it was like the dumbest app ever. I don't know why I liked it. But like you'd start with some money and then you'd like build something, put some more money into it, and then it would just like compound and grow. And you'd be like, after like 5 days, you'd be like, how much did my money grow? And then it was like, it went past quintillion and some other numbers. And I used to know them and now I forgot them all.
but I'll put that on the video because it's super interesting. It's like, yeah, like it's more than probably like a million times more secure to,
That's so crazy.
yeah, and winning the Powerball is impossible. And then if someone guessing your Bitcoin private key is so much more impossible, you basically are not ever losing your Bitcoin.
Did you end up transferring everything onto your ledger yet?
Man, let's not talk about it. I have not. I look at it
Okay.
every single day and I'm like, I need to do this.
It's just
But
scary.
I am slightly intimidated by it because it is, once you do it, if you send it the wrong place, it's gone. It is gone. So, retweet of the week. Those are a couple good ones.
Oh,
I liked
think I
them.
might have lost Cavan there.
Yeah,
Or
we
is
had
there?
some technical difficulties here. Can you hear me, Drew?
I can hear you.
Nice. We both glitched out, I think. But so that, I think, wraps up our retweet of the week. Let's move now into what's going on in the neighborhood. Anything of interest heading or going on over in your neck of the woods this week?
Well, we have brought our kid to daycare for the first time, like this last.
Nice.
We did like a half day last week, and then a half day on Tuesday, and then today on Thursday he had a full day there. So that was like
Nice.
that was kind of like the craziest
Big moments.
one. And it's like
are
it's weird because it's
having
like
some difficulties.
We've had
Drew.
him. He's only been with us for like
I don't know
months.
if it's on your end or if it's on my end, but we are losing each other. Are you back?
Oh yeah, but could you hear me?
No, I had no idea what you said. So, listeners, we apologize. This is probably going to be super choppy because, again, we're having troubles with Riverside. I shouldn't name drop. We're having troubles with our connection. And so we'll see how the rest of this episode goes. But yeah,
Well,
what were you saying?
I'll try to start over again. So this was like the first full day of daycare for our kid, and he's like 9 months old today, actually.
Nice.
He took like a half day earlier this week, like on Tuesday, and then like a half day last week or something. And neither of those days like went super well. They're like, he was like really sad, and it's like, it's like tough. Like I feel like I was just gonna be able to drop him off and be okay with it. But then you see him like crying, and then like they'll send pictures of checkups, and he's like smiling, I think, but his eyes are just like all watery and looks like he's been crying. Yeah, so you're like, oh my goodness. So
yeah, poor kid.
It'll take him a little while to get used to that, and it'll probably take a little while for the mom and myself to get used to that too.
I'm sure.
But that's
an adjustment, man. Sending your first to daycare for the first time, that's an adjustment. I know when we sent our oldest the first time, we were both very like on edge of like, is he doing okay? Like, is he sad? Is he having fun? It's a lot to go through. It takes a little bit of time to get used to as well.
Yeah, our kid is like really active. He's like never stops moving. Extremely smiley kid, and like the people that he's been around, like in our family, he's like completely fine. Like we can leave, he'll be with them, no problem whatsoever. If it doesn't, we bring him with us everywhere we go. So like he's like completely fine with going to other places. But for some reason, like going there, he didn't know any of the people that were there, and then he sees us drop him off and leave. And like the first day, he had like no idea that we're not coming back for a while, and then like now he picked up on it like the second and third day that when you drop him off there and walk out the door, he's there. So yeah,
he'll adjust.
So when we're here and he's like not moving or not doing all that as much like active stuff, not as smiley. It's like, oh, it kind of sucks because I know that's not him.
Yeah. Poor guy. He'll get through it. It'll
Yeah.
make him tougher.
It'll make him tougher. Hopefully he doesn't despise us for it.
That's the dad. That's the rules of dads, right? You have to make your kids a little bit tougher. That's the job.
Yep, you have to. Anything on your side of the neighborhood?
Well, not a whole lot. We went to the Washington County Fair tonight. And speaking of tough, our oldest was super pumped to go into this helicopter ride. As soon as he got in, he screamed the whole time he was on it. Just
legit helicopter?
It was a helicopter ride. So like helicopter shaped, like thing that just spins around. Essentially. Okay. Yeah. And he was scared, I tell you. And he came out, he's like, Daddy, that was so scary. I'm like, buddy, I'm sorry, but
it was not
really
scary.
Not that big of a deal. You really wanted to do it. And then he was kind of a SHIT head the rest of the night because of it.
A shathid.
But it was fun. So yeah, exactly. But it was fun. The first time we've been there, it was kind of like a mini state fair, a very mini state fair. But they had all like the good food, you know what I'm saying? Like deep
That's
fried,
the only thing I go to fairs
pull-ups, for. That good. Yep, exactly.
I will never forget County Fair, St. Louis County Fair. That's the county that I live in and Cavan grew up in. I can't remember if you were there or not, but we went to the county fair with Wes, and they had a Dairy Queen stand. And I went to get a Blizzard, but like all the Blizzards were just frozen. So you're eating like, it tastes like freezer burnt Blizzard. I ate it, and then we went on the pirate ship, and it just like went swaying back and forth. And it would just like got to that last part. I was like about to puke from like that shitty Blizzard I had. And then it was like that last little bit, it was just going back and forth, back and forth. I'm like, please stop. And then it just like slowly going down. I sprinted just off that thing. Sprinted off that thing right when it stopped after about a million sways and just threw up my entire Blizzard, all just my food that day, right in the back. And I just will never forget that.
Just pray to the heavens.
Every time I go to that county fair, and it's like, yeah, I puked right there.
You're gonna tell your son, like, you know what, son? See that spot right over there? That's where your dad let it ride. Yeah.
And sometimes if I get like a Blizzard from DQ and I don't finish it and I put it in the freezer, I take it out. It's just like a little bit of PTSD. I just look at that thing.
Well, I think, Drew, maybe that's where we leave the podcast off tonight.
Yeah.
I don't know any better way to end this episode.
Yeah, other than puking. But yeah, so that wraps up another week of the Neighborhood Money Podcast. It was a pretty fun episode. I wasn't exactly sure where this episode was going to end up. We kind of wanted to start a little bit more free flow, and I think it worked out very good. I was very pleased with how this turned out, talking about 401ks, IRAs, how they are different, and it's not always a retirement account that is able to fund your retirement. There's other options than just putting money aside into, say, an index fund. There can be entrepreneurial sides, so there's other options that way. So I hope this episode is able to clear up some of the difference between that 401k and the IRA. If there's any more questions that you guys have on those, let us know in the comments, because we would love to be able to talk with you guys and communicate a little bit more with that. But with all that said, we want to thank you again for listening. If you made it this far, we'd appreciate a thumbs up, a review, a comment, something. Outside of that, I want to thank you again, and we'll see you guys next week in the neighborhood.